like to spend a few minutes just to talk about the sectors that have been impacted by the conflict and that could be impacted by the conflict and our current oil market outlook with the conflict in the region in mind. Two sectors that we have seen probably the most impact on have been shipping and refining, especially in Europe, and that's mostly been driven by the turmoil in the Red Sea that we've seen and that Ziad has talked about. And of course, there's oil and gas. Hasn't been a huge impact, but they could be impacted depending on which scenario we end up in. And of course, in our full report on the deep dive report that we wrote on the subject, we go in to talk about the different players like oil majors, like the Gulf producers in OPEC Plus, the rest of the OPEC Plus group, non-OPEC Plus producers, and so on. But let's focus on shipping and refining to begin with. Essentially, since the beginning of this year, when we started having more attacks on vessels in the Red Sea region, we've seen, of course, a lot more vessels trying to avoid the region and going around Africa, taking longer journeys. And this has, of course, increased the freight rates in the shipping space, and it has increased fuel prices, especially diesel, especially in Europe, and therefore refining margins in Europe. But that's what we've already seen. And from where we are right now, which is a confined war scenario, that's our prevailing scenario. If we stay in a confined war scenario, or if we get a potential ceasefire, what we expect is that these high elevated shipping rates or refining margins would probably start to normalize in those two non-escalatory scenarios. But if we see escalation, for example, to the proxy war that Ziad mentioned, similar to the early days where we had higher risk of attacks on vessels, it's very likely that we see shipping rates increase further and refining margins, especially in Europe, increase further. If there's further escalation into a direct war, very likely that shipping rates increase even further. But for refiners, it gets a little bit trickier because in that scenario, we estimate, as Ziad mentioned, crude oil prices at $150 a barrel, if not more. And of course, for refiners, crude oil being the feedstock, this would probably turn a net negative impact for the refiners. And just to visualize, again, the Suez Canal traffic has dropped significantly, and we've seen that hike in freight rates, not as significant as the 2020 to 2022 period, but meaningful nonetheless for the shipping rates. When we look at refining margins in the first quarter, and this wasn't what we were expecting or the rest of the analysts on the street were expecting for refining margins, but we've seen a significant resilience in European refining margins at some point in the first quarter, levels that were higher than the 5-year average. And this has, of course, been reflected in the stock price performance of the listed European refiners. And then on to oil and gas. Again, we haven't really seen a big impact on oil and gas prices. And once again, if we remain in one of the non-escalatory scenarios, the confined war or the ceasefire, we don't expect a big impact or a big correction in oil and gas prices, which means very negligible impact probably on the oil and gas players as well. In a proxy war scenario where we estimate oil prices could inch towards $100 a barrel, probably a lot of these players, as long as their production is not impacted, they could benefit from higher benchmark prices. But then in a direct war scenario, of course, there is that heightened risk of direct attacks on energy facilities, and of course, the potential closure of Strait of Hormuz. Once again, as Ziad mentioned, this is a tail risk, low probability, but high impact scenario. But in that scenario, when you look at oil majors, many of which have exposure to the region, of course, Gulf producers, they could stand to lose in this scenario because higher benchmark prices, but a much higher risk for disruption on their facilities. But then the rest of OPEC Plus, of course, there are some member nations with meaningful spare capacity, and of course, outside of the region, such as Russia, Kazakhstan, and they could be in this hypothetical scenario, they could be in a position with room for them to increase their output to perhaps fill in the gap from some lost barrels from the region, and of course they would be in a position to benefit from the higher benchmark prices as well. So on oil prices, I mean, we have seen oil prices quite range-bound in the recent past with remarkably low oil price volatility. And I think one of the biggest drivers for that has been the meaningful spare capacity that OPEC is sitting on. And of course, as they delivered more and more output cuts, this has increased their spare capacity level. And this spare capacity usually provides cushion against unexpected supply disruptions for the oil market. And when we look at the supply-demand balance, we remain, we continue to expect a pretty well-supplied market, barring any disruptions for the rest of this year. And this is reflected in the analyst consensus estimates for Brent oil prices for the rest of this year, which remain quite steady. And in BI, we have our own fair value model, which is signaling a fair value of just below $90 a barrel. And this isn't necessarily because of the higher geopolitical risks. That is one of the drivers in our model, but not the only one. We've actually had other drivers that have been relatively bullish, like refining margins, like inventory levels, and that's been driving this elevated level of fair value. And the range bound I was talking about is essentially the $80 to $90 a barrel range where we continue to expect oil prices to be. And this is a range that we now call the Goldilocks range, because this is really a pricing range that is favorable for almost everyone involved. On the producer side, it's still favorable. It's still a good point for OPEC+. It's still good for non-OPEC+. It's good for oil majors. But also for consumers, this is a price point that's not too bad for consumers. It's not exactly a big demand destruction zone, and it hasn't been a level that's been refueling inflation all that much. And these relatively elevated oil price levels have been good for oil and gas companies. I mean, when we look at the last 3 months, 6 months, 12 months, it's mostly been green for global oil and gas companies. And of course, the oil price reactions historically have varied to Middle East conflicts. So far, we haven't seen a big impact, but it matters what happens next with the conflict on what happens next to oil prices. So, as I mentioned, this is all coming from a deep dive, a long report that we published recently. If you're interested in it, please get in touch with me. I'd love to send you a PDF or a hard copy of it. And that was it from me. Thank you very much for your attention. And up next, we have a panel on Middle East security examining economic implications, which will be moderated by Salman Sheikh from the Sheikh Group, who are also the hosts of this breakout. So thank you very much.